welcome to this video. My name is Dr.V.Meenakshi. I am the Assistant Professor of Commerce in the Department of Commerce CASF, working in Standard Fireworks Rajarathinam College for Women, Sivakasi. Today we are going to see about partnership accounting in this video. The learning outcome of this partnership account is to know about the basic concepts in partnership and to know the procedure of accounting treatment for the admission, retirement and death of a partner. First of all, we are going to see about the definition of partnership accounting. Partnership accounting definition was given under Indian Partnership Act 1932 in section 4. Here it means that partnership is the relationship between persons who have agreed to share profits of a business which is carried on by all or any one of them acting for all. Then we have to know about the main characteristics of partnership. That is, it is an association of two or more partners. That is, the minimum number of partners to form a firm can be 2. The maximum number is guided by Companies Act. According to that act, the number of partners should not exceed 50. The maximum limit is 50. And they have formed to do some legal business. Then there should be an agreement between all partners who involved in that business. The agreement should be mainly made for the purpose of doing business. That should be an legal business only. That should profit sharing ratio. It is very important that all the partners have to share the profits or losses which arise in the firm in equal ratio or the ratio agreed between them. Then there should be an agency relationship. That is, a partner is both an agent and a principal of his own business. A partner is an agent of his own business in the sense that he can buy new partners by his act, and a partner is a principal of his own business in the sense that he can be bound by acts of other partners of the business. Then liability of partners. Each partner is liable jointly and individually to third party for all the acts of the firm done while he is a partner. Next, we are going to know about partnership deed. Partnership deed is a document that consists of terms and agreement between the partners. It does not necessarily have to be written, but a written one is preferred by the law. So, a partnership can come into existence only after all the partners have signed the deed. The deed is important thing. Here we are going to see the contents of partnership deed. That means the main thing which is incurred in the deed. First of all, the name and address of the firm and their main business will be included. Then the name and address of partners, amount of capital contributed by them, then their accounting period, date of commencement of partnership and what rules they are following in operating bank accounts, their profit and loss sharing ratio, all has to be mentioned. Then the rate of interest on capital, loan and drawings percentage, then the auditor's appointment, everything has to be specified in the deed. The salaries, commission, etc. which is payable to the partner has to be specified. Then the rights, duties and liabilities of each partner has to be known. The treatment of loss, when there is loss arising at the time of insolvency of one or more partner has to be clearly specified. Then the settlement of accounts on the process of dissolution of the firm has also to be specified. Then the mode of settlement, if disputes among partners has to be specified. Then it has to specify the rules to be followed in case of admission, retirement and death of partner. Any other matters which related to the contract of business has to be specified in the partnership deed. Next, we are going to see about the admission of a partner. Admission of a partner means a partner is entering into the business which already there will be a partners. Here we can see that 3 partners is existing there. Another new person Agni has coming into partnership. For this purpose, she has to provide capital as well as goodwill share. Then only he will become a partner. For doing this, there is a lot of accounting treatment also. First of all, we have to calculate the new ratio for the partner, as well as we have to specify the sacrificing ratio, which means the old partners is sacrificing their share for the new partners coming into the business. Then the next treatment is treatment of goodwill. If the person has to bring cash for his share of goodwill, that amount will be shared by old partners according to the sacrificing ratio. If the new partner is not able to bring the cash, means a goodwill account has to be created, that has to be in the name of new partner. That amount will be credited to the old partners in their sacrificing ratio. Another important adjustment is revaluation of assets and liabilities. If your partner is entering into a business, means in the balance sheet, that is, we are already having assets and liabilities, that has to be revalued. The net figure, it may be profit or loss, that will be shared only by the old partners according to old ratio. The next important adjustment is capital adjustment. That means the new partner bringing in capital, the other partners has to adjust their account according to the capital brought in by him. The next important adjustment is treatment of accumulated profit and loss. That is, it is already in the balance sheet, any accumulated profits, means that will be shared only by the old partners according to the old ratio. Next, we are going to see about the retirement of a partner. Like admission, if any one partner says that I am going out of business, means the other 3 will carry down the business. That is called as retirement. Like admission, for retirement also there is a lot of accounting treatment. First of all, here also the person is leaving, we have to find out the new ratio. Here we have to find the gaining ratio, because the partner is left the business, his share will be shared by the continuing partners or remaining partners in the concern. So that has to be calculated. Then treatment of goodwill. Here the share for goodwill alone will be given to the retiring partners, that will be done by the remaining partners according to the gain they are receiving in the business. Here also the accounts will be revalued, assets and liabilities. Here profit and loss will be shared by all partners in the old ratio. The accumulated profit and loss treatment will be the same like admission. Then up to his retirement, he may not retire exactly at the close of the year. He may be retiring in between. That means up to his period, he is having a right to receive the profit for current year. Then his share will be given to him. Then settlement, his account will be settled in cash if the firm is having enough cash. If the firm is not having enough cash, that settlement amount will be transferred to his loan account. Future it will be settled in some installments. Next, we are going to see about death of a partner. See, the death means it occurs any time. It may be due to some accidents or anything. It is an uncertainty thing. If any partner death occurs, means what they will do means they will appoint a legal hire for the partnership. That person will continue the business. If he is not willing to continue, means he can take all the shares of the death of a partner and leave the business. Here also the accounting treatment will be the same which is we are doing at the retirement. But only in settling accounts alone there is a difference. Instead of partners, we will be using his name as executor. So, all loan and installment amount has to be settled only in the name of executor, not with the partner's name. Then the dissolution of a partnership. If they are doing a business for a long time, if they are incurring continuous loss, means the partners will decide among themselves to put a close to their business. That is called as dissolution of partnership. For doing this dissolution, here also there is a lot, some accounting treatment is there. For dissolution, we have to prepare a separate account called realization account. That account is prepared to revalue the assets and liability, not revalue, to realize all the assets and liabilities in the business. That means the asset will be sold out and the liabilities has to be paid off with that amount. If any remaining capital or balance is there, it all will be shared by all the partners in their old ratio. Here this comes and putting an end to their business. That is, many persons prefer doing business in the form of partnership concern due to the shared risk and responsibility in doing the business. The liability of partners is usually shared by all partners in the concern, so automatically it is a great support for them. If any dispute arises between them also, they will ready to close the business, that is not with much responsibilities. That is the end. Thank you all for seeing this video.